friends, another interesting topic close to my heart, something that I'm very keen to listen to. You love it or you hate it, but you cannot ignore it. What's the word? The word is crypto. Open the paper any morning, and if you don't find an article on crypto, I bet you do. We have all been confused completely about crypto. I mean, believe you me, I do a lot of reading, but crypto is a very confusing word. Is it good? Is it bad? Is it evil? Is it the future? That's all we all want to find, right? And clients are constantly asking, crypto has given so much of returns. Why aren't you recommending cryptos? How can I recommend if I don't know it? That's where Kavitha Menon comes in. Our next speaker, Kavitha Menon, is the founder of Probitus Wealth. Kavitha has 15 long years of experience in wealth management. She has been earlier with Parag Parekh Financial Services as a vice president. She holds a degree of CFA and she has an MMS in finance from Mumbai. And Kavitha is going to give us an enlightenment of what crypto is all about. So the cryptic word crypto is going to be encrypted, let me put it that way, by Kavitha. Over to you, Kavitha.
Okay, so good afternoon, everybody. This is Kavitha Menon, and I have been doing some study on cryptocurrency because there's been so much demand and so much interest amongst our investors for this particular asset class. In this presentation, I'm hoping that we will understand what exactly this blockchain technology is, why are clients interested in crypto assets, what are the different types of assets, and how should advisors look at this investment class from the legal sanctity point of view, and how to set up expectations from the point of view of crypto returns and rewards. So let's just jump into the very start of what is blockchain technology. Let's just understand the technology that goes after it. In a regular setup, we are used to we all use the internet, and when you use the internet, you would have heard the terminology of servers, the server crashing, and suddenly Facebook doesn't have it's down for a day, or there is a server problem. Now the reason why this happens is, in the internet that we know of, you have centralized servers or databases, and those servers transmit data to several other laptops, computers, or any devices to which the servers are connected. And from the server, it becomes like a centralized storage system for data to be saved, stored, and then shared. If we look at this as compared to a distributed database, you will see in a distributed database, you will have many servers. Each laptop device on such a server serves as a database. A copy of all information and data is stored on not just one centralized database, but on several. This is called a distributed database. Here, it's also called peer-to-peer. If you've heard of these terminologies, they're all the same: peer-to-peer, distributed database, and this is the basis on which blockchain technology works. Why is a distributed database better than a centralized one? Is because in a distributed database, you will be able to share data on real-time basis. There is no downtime. If one laptop crashes, then you still have other laptops that are connected to the network, which will function, and data will still be saved and stored and shared without any downtime. On the basis of distributed database, blockchain technology works. Now, blockchain is the technology which protects data and stores it in blocks of data which are chronologically stored. Now, I'll explain this as very technical, but when you understand with an example, you will know what exactly I'm talking about. Generally, your distributed ledgers will be either private ledgers or public ledgers. A private ledger is something like say a pharmaceutical company which is using a distributed ledger system for the purpose of managing its say supply chain. Here only those people working within the company will have access to its to the database. So this is a private database, a private ledger. A public ledger is what you are interested in. This is where the whole crypto space and the whole crypto technology is working out of. Distributed ledgers allow anybody to join. You, I, we can have our laptop, put the software, and we can become a part of the chain, the blockchain. And you will, as participants, you can also mine crypto tokens. You can participate in businesses which are running on the blockchains. So it's free for all. There is no single entity that is controlling or overriding the rights. It's all run by smart contracts or algorithms that run the whole public distributed ledger systems. Yeah, so this is your public ledger. Now, with an example, I'll try to explain how tokens have come into place and how you have to understand how they can be valued and what type of businesses they will represent. Now, in a traditional system, let us assume that there is a transaction, a property sale between Kavitha and Lakshmi. Yeah. So let us assume that Kavitha is selling her asset and Lakshmi is buying the asset, and there is a transfer of money that occurs between Kavitha and Lakshmi. In a traditional setup, what we do, we go to the registrar and we register the property, right? Now, this is a central authority. Supposing the registrar's office burns down, your document is also destroyed. The information that you have given to the central authority is destroyed. What if there is a hacking that is done on the system of the central authority? Now, these are the possibilities that can happen in the real world. In this example, let's assume that Kavitha and Lakshmi decide to do not trust a central agency, and they decide that they need to go to a distributed ledger system. Here, what will happen is there will be an agency of 12 different lawyers sitting in 12 different parts of the world who will ratify the transaction, ensure that the documents are in order, and once the transaction is done, they will keep a record of that transaction. Now, what happens in a system like this is, if supposing any one of them has the data destroyed, or there is a fire, or any of this hacking system happens, the other lawyers will still have a copy of the transaction and the document. These transactions, they will keep recording in a ledger, one after the other in chronological order, in blocks. So in a blockchain, this is called blocks of data. Ledgers are called blocks. The data is stored, and anytime there's a transaction, let's say now Lakshmi wants to sell it to another person. Say she sells it to Asha. When she does that transaction, that is also recorded in the ledger, a copy of which is maintained by all the 12 lawyers in the agency. This ensures that the transactions are ratified by a majority of the lawyers, so it is correct. It is irrefutable because you have to, if you had to do a fraud and you had to make some changes in the transaction list, you will have to do it in the list of you will have to make changes in the records of all 12 lawyers sitting in 12 different parts of the world. So this system is better than a central agency maintaining record of transaction and the document of transaction. If we had to move this transaction to a blockchain system, then what happens here is Kavitha and Lakshmi will go with the document of the property document to App Legal, which is an application which will convert it into a NFT, a non-fungible token that can be transferred using, say, the Ethereum network. Let us assume now this Ethereum network is the agency, and the lawyers here will be called mining nodes. The mining nodes ratify the transaction and maintain records in blocks of data, which is chained together in a way that they are chronologically listed. This is why they are called blockchain. And the way the data is saved in these blocks of data is with cryptography, it is protected. And hence it is much, much safer and unhackable. They say it is unhackable compared to a centralized system. Here, there is no central agency. There is no one person who decides how the transactions are going to be done or how they are going to be saved. It is done by the system. It is done by smart contracts. There is no human intervention. Smart contracts will ensure that the data is safe, and the transactions in the NFT is very well documented for future use also. So the ownership of the NFT is verified without any doubts. This is a very practical example of how blockchain is working currently. Right now, how does Kavitha and Lakshmi pay for the services of App Legal and the Ethereum network? There are two types of services they have actually taken. One is to tokenize the document, which is done by App Legal. And the other is the transfer itself, the transaction itself, which is done on the Ethereum network. Now, to pay for this, they will have to buy Ether, which is the token of the network. They have to pay via Ether. They can pay App Legal also with Ether, or App Legal may have its own token, which you will have to buy from an exchange and then pay them with the token. This is the utility of your tokens. This is what is cryptocurrency. So because you have to buy services or products using these tokens, they are called currency, but they're really not currency. They're just basically tokens which are used for payment for using particular services. For using the chains, the blockchain networks services, you pay by Ether, and they're called gas charges, gas fees. The fees for the fees that you pay, the nodes, the mining nodes for doing the part of verification, it's called gas fees. And App Legal, the fees that you pay them is for the purpose of tokenizing and then maintaining the record, etc. So that again you need to pay them using tokens. It could be either Ether, the token of the network, or you may pay them using App Legal's own token. So in terms of blockchain uses, already there is tremendous usage already happening in the business space, in places like I just told you, real estate registry. Governments are using blockchain to maintain records of birth certificate, death certificates, medical records, the passport details, so that there is very little risk of hacking, very little risk of any damage to the data, and it's also very protected, especially sensitive information that needs a lot of protection from hackers. Blockchain has the ability to give them that protection of data. In shipping, logistics, in supply chain management, in Internet of Things. What is Internet of Things? You sit in one place and you can manage devices sitting in 5 different places. You handle the devices, you can switch on, switch off, make them move, make them do things using a single device or single, say, a mobile phone. That's the Internet of Things. In shipment tracking, blockchain has tremendous usage because there is very little downtime when you're using blockchain technology. And it is very essential in the business of shipment tracking, in the business of supply chain management, so that so for example, Truckle or Dex Freight, which are based on blockchain, they help you manage your logistics. You will know at any point of time where your trucks are, what are they carrying, how much load are they carrying, where is the location of the trucks. That's what Truckle does, for example. And their application runs on blockchain. So a lot of actual usage is already happening in the last 5-6 years. There has been tremendous upside in the number of usages for blockchain. Now I will take you to crypto assets and where we as investors or investment advisors can help. Typically, you must understand what type of tokens are available. The first type of token is your payment tokens. They have no utility value. The biggest, greatest example of this is Bitcoin, but they own the largest network of servers or miners. The largest number, it's the largest network by size and market cap also. By itself, Bitcoin has no value. It does nothing. It just gets transferred from one person to another. Similarly, Ripple is used by bankers to transfer money. Litcoin is a smaller type of Bitcoin token, payment token. So these tokens by themselves do not have any other utility other than being payment. They enable payments. So the first type of token is this, the payment tokens. The other is the utility tokens. So similar to the example that I gave you of Ethereum, where Ethereum is like a chain of computers which will do the verification work for you, and for doing that work you pay them gas fees. So they are called utility tokens. You pay for a service. You can use Ether to pay for the services of several applications which run on that blockchain. Yeah, Cardano is another. So these are basically classified as utility tokens. The third one, and before I take you there, I'll just explain the concept of initial coin offering. What happens is, now I gave you an example of App Legal, which is an application which will tokenize your property documents. Now, if App Legal is created by a bunch of developers, they can come up with a initial coin offering, very similar to an IPO, where they will issue coins, and people who are interested for two things. One, they are interested in using App Legal's own service, or they think that App Legal service is so good that we can buy the tokens and then we can sell them later for a profit, right? So an initial coin offering is done by the developers, and they get the money to to create more features in the application, or they can just run away with the money, but that's also happening. Because in this space there is no regulation yet. So what app developers do is they come up with the IPO, initial coin offering. You can raise money in this form. So this is a new form of raising capital. Right now, just to give you an example, Binance is a coin that was issued by the Binance exchange, which is required to use the services of the exchange. But now Binance is a token by itself is also being transacted to buy other tokens or to use other services. It is accepted as a currency in the crypto space. Sorry, excuse me. So developers will go for an initial coin offering. It is similar to an IPO. So from the concept point of view, you will understand this. And what these tokens do is, these tokens which are issued by application developers, there can be many variants in this. This could be a governance token where you will participate in voting rights and you have a share of revenues. So a lot of DeFi platforms like SushiSwap, PanSwap, Uniswap, these have they share revenues. If you buy their token, you actually get a revenue inflow from the project's business. Okay, there are others which are similar. They're just tokenized versions of equity. So you will have a token, but it is just really equity only, which is in a tokenized form. And these are under jurisdiction of local regulators, and they will perform similar to security, but they're in a digital form. It is something that you can transfer on a blockchain. Okay, and there are others like stable coins, which are pegged to dollars or to a precious metal or to a currency. So those are stable currencies. And the NFTs are what I discussed with you. They will be physical assets. They're called non-fungible because they are unique. Unlike the tokens, one Ether token is similar to the other Ether token. One Bitcoin is similar to another Bitcoin. But in NFTs, they represent physical or digital assets. So if I've sung a song, I can digitalize it, I can make it into an NFT, and that becomes a digital asset for me, which I can sell. So I'll explain this also in terms of how, when, where people are interested now. So why is it such a big thing between millennials especially? The first thing is, of course, it's very easy to open an account, very easy to transact. You can buy, sell at a click of a button. But most importantly, there's also a lot of adoption. So there are merchants, there are, so many, Visa has just recently had a tie-up with so many merchants to accept cryptocurrency. So there is acceptance. big investors are coming in and putting money into crypto assets. There is a fear of limited supply in certain tokens like Bitcoin. Okay. And for especially the youngsters, they are actually using applications which are running on blockchain, be it gaming applications, be it in the space of DeFi. DeFi means where you can buy, just like in banking, where you can lend money, you put money in a fixed deposit, you earn interest, or you can borrow. Youngsters are using DeFi to earn money on their tokens or to borrow tokens also. So that is also happening. So just outside the banking system, in a very unregulated space, you are able to do a lot of financial transactions, right? So the younger generation understands this faster, and that's why there's a huge amount of acceptance for crypto assets. Now, from the millennial point of view, they are looking at it like we would have looked at equities. They think that this is the next big way of raising capital for digital businesses, which is true. The tokens may exist for a very long time. Once they get regulated, they might just become a new way of participating in the business of a company or a business which is available on a blockchain. Okay, you can participate in revenues in the blockchain. If you believe, let's say, Ether, to create that number of nodes or to create that huge size of a blockchain takes a lot of space, time, and money. So that's why Bitcoin is the largest, right? It's the largest, and therefore they call it digital gold. Now, it's very difficult to replicate a blockchain once it attains a certain amount of size. If you believe that you can build applications and you have to pay for the use of those applications using utility tokens, then networks like Ether become like real estate, so you can participate in the growth of those assets by buying. It's like buying real estate. You're participating in the growth of the blockchain by buying the tokens, right? And there are uses. Like I said, there is a use case. The youngsters are using tokens in the gaming space, in the DeFi space, and because they are seeing the usage of it, there is also acceptance and more participation. How can advisors look at legal sanctity now? So from the legal sanctity point of view, first and foremost, it is not legal tender, although it is called currency, because this is not issued by RBI, or neither is it accepted as a currency by any governments. So not a currency by definition. However, you can purchase digital assets and services. Like I said, like you could purchase the services of the company App Legal that I spoke about to tokenize your property transaction. Then you could pay gas fees to the Ether blockchain using Ether. So these are, you can purchase services using crypto tokens. So it's a means of exchange of value, but unfortunately, as we speak today, because cryptocurrencies, there is no regulation and there is no defined way of valuing them. They are also very volatile. It's not a hold of value. It's pretty volatile. It is not a hold of value. If one believes that a particular blockchain will see rapid adoption and growth, then it works like a real estate, and one can participate in it by buying the token or the utility token of that particular blockchain. They are basically a new form of participating in business. They are a new form of participating in business. We'll have to accept that this may be something all of us advisors will have to learn about. If not invest or advise on right away, but you will have to learn how you participate in businesses using these tokens, right? Also, this is a ever evolving space from the legal standpoint. Although exchanges have been asked to do proper KYC, now their crypto asset gains are going to be taxed also. One must remember that a large number of transactions happen outside crypto exchanges, and there is no way the government can monitor these transactions, let alone tax them. So it's very early days for the government also. They are also learning on how to regulate. Also, if you recollect, in the early equity days, there used to be so many scams, so many people coming up with run of the night, promoters coming up with IPOs to raise money. Today, we are seeing that same thing happening in the crypto space. Today, anybody can sit down, 3-4 laptops, beto, you take your, you put in the software and you can issue tokens, you can print tokens. It's very easy to create tokens and then come up with some hype around them and then hype up the price and then run away with the money. It is very easy. It's happening all the time in the crypto space. Also, as advisors, RIAs like me cannot advise on crypto till they get regulated. So it's anyways out of the regulatory standpoint of view, it is out of our scope of work. There are no products on which distributors can make any kind of gains by selling them also. So even from the point of view of distribution business, or as from the standpoint of making some money by advising, there is really no framework right now available for advisors to make any kind of fee-based income out of crypto assets. Now, setting the right expectations with crypto returns and rewards, and this is my favorite space, and this is something this is the most important part of the whole presentation, is the risk that is there in the crypto assets. First and foremost is regulatory, I just spoke about. The governments across the world are very, very skeptical because there is a huge amount of money laundering, tax evasion that is happening using crypto assets. Plus, because these assets have no face, there's anyways no regulator. But supposing there is a scam, supposing there is a problem with your investment, there's no face. This is all run by computers, smart contracts, or whatever. If you lose money due to fraud, or if somebody hacks into your system or something, your keys are lost, there is no recourse to anything except for your own self. I mean, there's nothing. There's no recourse for an investor to get back money. This is your biggest risk in crypto assets. They're extremely volatile, and hence, it's not really a store of value. You will see, Bitcoin, for example, going up from 60 odd $1,000 and then collapsing to half within a matter of a week. That's the kind of volatility that you have to stomach if you're invested. I mean, some of the assets in the last 2-3 months, some of the crypto assets have collapsed by 90%, 99% even. Certain assets like Bitcoins, etc., Bitcoin tokens, they require huge amount of energy, because they work on a concept called as proof of work. That means the majority of the mining nodes have to ratify a transaction. So you can imagine, and they have to do that ratification, there is a cryptographic mathematical problem that they have to solve so that they can ratify the transaction. Now, this whole process, and as more Bitcoins are being minted, that algorithm is getting more and more difficult to crack. So if you look at these mining nodes that do Bitcoin mining, the huge amount of computing energy that is required by them, their computers or their the processing nodes are so huge, and they almost occupy entire farmlands. So China took note and banned the Bitcoin nodes, because the amount of energy they were consuming was so tremendous that they were going into a crisis, into an energy crisis. So it is very difficult for us to see how something that is so energy inefficient and so expensive will continue to last or stay in the next, say, 5 years or 10 years. So there is a problem with this energy consumption thing also with certain blockchains like Bitcoin. Also, the charges for doing transactions is only increasing, gas fees, etc. Like I said, is the fees that you pay for the purpose of verifying transaction. The fees are pretty large, and sometimes they're so large that they don't justify the positive aspects of doing any business or applications on blockchain. So that's another issue here. Although the younger, there are new blockchains that are coming up which are more energy efficient, which have lower gas fees. But that's also a risk, because every 2-3 days you have some new technology coming in. That space is changing so rapidly, and new blockchains are coming and doing better work. So because the technology is changing so rapidly, that means the older technology becomes redundant. Will it become redundant? We don't know. We're still at the cusp of it. But if that happens, then again you will lose money in the older technologies. So this is basically where your risks stand. The overall risks are very high if you don't understand the space. And even if you did understand the space, your biggest risk is also that there is no way to discover what is the intrinsic value of these investments. Many of the companies which are launching tokens don't even have a proper revenue model in place, let alone a running business. So very difficult to discover what is the price you're paying. Is it a good price? Is it a correct price to pay? This is your big risk in crypto assets. So how do you do asset allocation and suitability? How do we help clients? So my own feeling is your exposure should be anything from 0 to 5%. Why 0? Because it's not necessary. You don't have to get into such a risky space for your investors at all. But if they are very keen on it, and they're absolutely wanting to have this, then 1%, 2% max 5% is what I would suggest. How you can allocate? You can buy into a basket. So you buy some stable, a little bit of asset-based tokens, little bit of DeFi, or you do a simple market capitalization kind of basket where you will buy just the largest 5 currencies. So Bitcoin will come in there, Ether will come into there, Solana will come into that. Another way to do it is to buy an index. So many of your crypto exchanges also offer an index which they manage. That's a good way to get in if you're a starter. You can also invest in a fund which invests in blockchain technology. So Invesco was supposed to come up with a fund. Unfortunately, because there was a change in regulation and there was some confusions, they did not come up with the fund. But the fund that Invesco was bringing out was a blockchain fund that invests in the equities of companies which are in the forefront of blockchain technology. Now, so if you're participating in blockchain technology, it is not necessary you have to do it through tokens only. You can do it through the equity of those companies as well. You can also do it through structured investments. There are many ways of doing it, but tokens is one of the ways in which one can participate in the businesses that are running on the blockchain. So you can start with opening an account with a cryptocurrency exchange. There are popular ones in India. Binance is there, WazirX is there. Fairly simple account opening process, is all online. You also have these subscription-based services where they recommend what to buy, what to sell. But remember one thing, lot of transaction or trading that happens in crypto is based on technical parameters. Fundamentally, there is nothing. In fact, it is zero. So when they say we are trading in cryptocurrencies, it's either speculation or it is based on technical factors, not on fundamental factors. So, but if somebody wants to do it, there are subscription-based services where you can do trading in cryptocurrencies. If you want to invest as a long-term investor, then I suggest go for an index or an ETF, or go for a fund that is managing crypto assets like the Invesco fund. They are listed abroad. It's a fund that exists abroad. So you may have to put money via LRS if you want to buy that now, or you wait till the fund launches in India. For very large net worth investors, there are AIFs available, alternative investment funds available, which are listed in Mauritius or Cayman Islands, etc., where they invest in a combination of tokens, equity, structured debt, structured convertibles, etc., in businesses which are in the blockchain space. But the amounts are very large. The entry levels are mostly 200. The LRS limit $250,000, and it is strictly meant for HNIs who have a capacity to take the volatility that will come. Because even if you're investing in equities or tokens, the volatility is very high because these are all developing technologies. They're not exactly well entrenched. And in these businesses, when you're going right in the beginning of when they're very, very young, or very, very they're just startups, so the risk of them going bust and not making money for you is very high. And that is something that is it doesn't change just because it's blockchain and just because it is tokens, etc., etc. The risk that we take in investing in crypto assets is very, very high, as at this moment at least. Even from the business, irrespective of regulatory risk, it is high even from the business risk point of view. So that brings us to the end of the presentation, and I wish to thank IFA Galaxy for giving me this chance to speak about crypto assets. I hope it has made the asset class a little bit more simpler for you to understand. And please let me know if any questions, etc., need to be passed. You can send me an email. I will have the email address shared with the IFA Galaxy team.